Welcome to good evening to everybody and welcome to my teachers program. So today is my third section. So the last classes we are discussing the admission of a partners and what are the points should be considered by the partners at the time of admitting a new partners, and what are the problems which is faced by the existing partners at the time of admitting a new partner, and also under what circumstances a new partner may be admitted by the existing partners. And also these are the main things what we are discussed in last classes. And today what I am going to discuss the problem which is faced by the existing partners at the time of admitting a new partner, and also simultaneously we are discussing the retirement of partners and death of a partners. So this is the main section which is belongs to first term. So today listen, see what I am going to discuss the previous portions what we are discussed, the goodwill treatment, and also how we are ascertaining the value of goodwill, and what are the different methods and different methods for valuing the goodwill, and at the time of admitting a new partner what are the problems faced by the existing partners. So once again for just for the information, so just explaining once again the point what we have studied last section. So you know that under certain circumstances the existing partners are admitting a new partner, and as per the law with the consent of all other partners a partner can be admitted into the firm. But at the time of admitting a new partner, the existing partners, see example, A and B are partners, existing partners, they likes to appoint a new partner C. So here my question is, what are the problems faced by the existing partners? You know that the problem number one, they want to change the ratio. So point number one is change the ratio. So that means they want to find out new ratio, and also they want to find out sacrifice ratio. So you know that old ratio minus new ratio is equal to sacrifice ratio. So the first point or the problem or the cases or the adjustment which is made by the existing partners, so that is A and B at the time of admitting a new partner C, that is change the profit sharing ratio. And point number what we are already studying, the goodwill treatment. The second point is the goodwill treatment. So second point is the goodwill treatment, and third point is revaluation of asset and liabilities, and point number 4 is distribution of undistributed profit and losses, distribution of profit and losses or undistributed profit and losses, and the last point is the capital adjustment. And out of that in detail we are already studied the change the profit share ratio and also the treatment of goodwill. So today what I am going to discuss is the revaluation of assets and liabilities. You know that the goodwill is an intangible assets which we can't touch and see, and also along with the capital the new partner is bringing certain extra amount, that amount is known as goodwill. And the goodwill, lot of adjustments are there. The goodwill which is given by the new partner to the old partners privately outside the business, and the goodwill is given along with the capital, and at the time of admitting a new partner the goodwill is already existed in the firm, and also at the time of the new partner is unable to bring the goodwill, and also sometimes the new partner is bringing a part of the goodwill, and also sometimes instead of bringing goodwill in the form of a cash, maybe the new partner is bringing an asset. So like you can see the different treatments are there, and on the basis of these different treatments we are passing a lot of transactions also. But now you can see the next point is the revaluation of assets and liabilities. You know that at the time of admitting a new partner, our the present assets and liabilities may be revalued by the existing partners. So that means the assets may be appreciated or the assets may be depreciated. So the second chapter you are already studied, change the profit share ratio. In that chapter you are already studied how to maintain or how to prepare a revaluation account. So here my point is, at the time of admitting a new partner, so the existing partners are revaluing our present assets as well as liabilities. See example, the land and building may be appreciated by 10%, or stock may be depreciated by 5%, and provision for bad and doubtful debts may be increased to 5%, and unexpired insurance premium should be there, and creditors certain amount including sundry creditors may be given back. So like that you can see lot of adjustments are there. So and on the basis of that we are making a revaluation account. So then after making this revaluation account, either you will get the net result of this revaluation account may be either a gross profit or a gross, either a profit or loss, either a profit or a loss. So we are getting the profit or a loss, and if it is a profit, transfer to partners capital account credit side, and if it is a loss, we are transferring to partners capital account debit side. So now listen, so we are studied 3 points. The first point is known as change the profit sharing ratio. That along with that we are preparing sacrifice ratio. Old ratio minus new ratio is equal to sacrifice ratio. When we are doing the problems, I will show the items how to calculate and all. And the second point is the treatment of goodwill, and third point is known as revaluation of assets and liabilities. And next point, fourth point is distribution of profit and loss. So normally the examination they are asking some questions, give 2-3 examples for undistributed profits, example general reserves, and also you can see the profit and loss balance, and also workmen's compensation reserves. So like that undistributed profits are there, so that profit is transferred to partners capital account credit side. So general reserve account netted to partners capital account. So that means, so when we are posting to the partners capital account, by general reserve, by workmen's compensation reserve, by profit and loss. So this is belongs to profit. Sometimes undistributed loss also there, example deferred revenue expenditure like advertisement suspense or profit and loss credit balance. So like that that profit we are putting to the partners capital account debit side. So that means the fourth adjustment is known as distribution of profit and loss account. And the last point is known as the capital adjustment. So this is a very important adjustment. At the time of admitting a new partner, they are going to rearrange the capital of existing partners. This method you can see the proportionately. So we are going to rearrange the capital of existing partners. So at the time of admitting, they are already given new partners capital, and on the basis of the new partners capital, we are going to rearrange the capital of other partners. And again, that is the one method. And the second method, under capital adjustment, 2 methods are there. Sometimes the new partners capital is given, and on the basis of that we want to rearrange the capital of other partners. And the second method is, under this method new partners capital is not given, that you can find out on the basis of other partners capital account. So these are the main adjustment, and these are the main clauses what the existing partners done at the time of admitting a new partner. So here we are, the main point is the goodwill treatment and also sacrifice ratio, and the last point and third point revaluation, and the last point is that capital adjustment. So these are the problems and adjustments which is made by the existing partners at the time of admitting a new partner. So now I am going to discuss the main point is the capital adjustment. So because we have already studied the previous section, so the main goodwill treatment and journal entries. Now today is a very important section and important points what I am going to discuss, that is capital adjustments. See example, A and B and C are partners. So listen, A and B and C are partners. Their old ratio is given. See, I am giving only the point. So A and B and C are partners. Their old ratio is 2:3:5. So three partners are there. Their old ratio is 2:3:5. They are going to appoint a new partner D. So they are going to appoint a new partner D for 1/6 share in future profits. They are going to appoint a new partner D for 1/6 share in future profits. And the new partner's capital is 32,000. The new partner's capital is 32,000. And on the basis of this new partner's capital, they are going to rearrange the capital of other partners. So once again I will repeat this question. So in brief I am giving the points. So A, B, C are partners. Their old ratio is given, that is 2:3:5, and they are going to appoint a fourth partner D for 1/6 share in future profits, and D is contributing the capital is 32,000. And here my point is, on the basis of the new partner's capital, we are going to rearrange the capital of other partners. In this case, first we are going to calculate the new ratio. So how to calculate the new ratio? So you know that the profit is equal to 1. So therefore 1 minus 1/6 is equal to 5/6. Therefore A's new ratio is equal to 5/6 into 2/10, and also then B's ratio is equal to B's new ratio is equal to 5/6 into 3/10, and C's new ratio is equal to 5/6 into 5/10, and D's ratio, new ratio, is equal to 10/10 into 1/6. So there you can find out that is 10/60, and this is 15/60, and this is 25/60, and here it is 10/60. So the ratio will be 10:15:, and 25:10. So we can reduce by 5. That means 2:3:5:2. So look at here. So we are already calculate the ratio. So the new D's share is equal to 1/6, and also the new partner's capital is 32,000. And on the basis of the new partner's capital, we are going to rearrange the capital of other partners. And here we want to find out the new ratio. So here the new partner's share is equal to 1/6. So what about the remaining share? 1 minus 1/6 is equal to 5/6, and 5/6 into old ratio, that is 2/10, and B's ratio 5/6 into 3/10, that is 15/60, and C's ratio is equal to 5/6 into 5/10, and D's ratio, the total of this, that is 1, that is 10/10 into 1/6. So the ratio will be 10:15:25:10. So that we can reduce by 5. That means the new ratio is equal to 2:3:5:2. Now listen. So here my point is, at the time of admitting a new partner, our fourth point is the capital adjustments. So in my question, A, B, C are partners. They are going to appoint a new partner D, and also for 1/6 share in future profits, and D should bring capital is 32,000, and on the basis of this D's capital, we are going to rearrange the capital of other partners. So here first we are going to calculate the new ratio. Now we already found out the new ratio is 2:3:5:2. So the new ratio is 2:3 and 5:2. This is what is called the new ratio. Now listen, next point is, on the basis of the new partner's capital, we are going to rearrange the capital of other partners. On the basis of the new partner's capital, and we are going to rearrange the capital of other partners. That is, you can see all of you listen here, look at the monitor. So here the capital, the new partner's capital is 32,000. That is 1/6. Therefore, the total capital is equal to 32,000 into 6/1. That is, I think, 1,92,000. the total capital is equal to 1,92,000. So listen, so the D's capital is equal to 32,000, that is 1 by 6. Therefore, the total capital is equal to 32,000 into 6 by 1, reciprocal 6 by 1, that is 1,92,000. Therefore, A's new capital is equal to 1,92,000 into their new ratio. You can see 2:3:5:2. That means 2 plus 3 plus 5 plus 2. That is 12. 2 by 12. And also this is for A, and B's capital is 1,92,000 into 3 by 12. And C's capital is 1,92,000 into 5 by 12. And D's capital we know 1,92,000 into 2 by 12. So this is what is called, the answer is 2 by 12, that is 32,000, and 1,92,000 into 3 by 12, that is 48,000, and 1,92,000 into 5 by 12, that is 80,000. So the last one, that 32,000, because when we are getting 32,000, that means our calculation is correct. So here once again I am repeating. So now we got the new partner's capital. So here our logic is, on the basis of the new partner's capital, we are going to rearrange this capital, and this capital, the new capital, we are putting in the partner's capital account debit side to balance carried out and take out the difference. So that means debit side is more by cash and credit side is more, we are writing to cash. So by cash means we are getting amount, or the partner is bringing additional amount, and to cash means the firm is giving amount to the partners. So by cash means you are adding with the cash account is increasing, and to cash means the cash account is decreasing. Now this method is known as capital adjustments. I think it is clear now. The students is a very, very important, because you just go through the last year's board examination question paper. So 8 mark question is from admission. So that's there, you can see, just look at now itself, just go through the question paper, you will get the last adjustment is on the basis of the new partner's capital, they are going to rearrange the capital, and also the excess and deficit of amount should be transferred either into cash account or a current account. So that is the way the board is asking question. Admission 8 mark, and retirement and death, and that is a word question, and dissolution also another big 8 mark question. So that means this is a very, very important. Today morning also I got lot of feedback from my teachers as well as my parents and students, and they are telling that this kind of class are very much helpful for them. So that is why those who are observing my class, just go through that admission. That is a main chapter for especially for board examination, and that's why I am explaining. So this part is very, very important. The students who are going to write the board examination, and also maybe tomorrow, day after tomorrow, many students have unit test and midterm and first term examination is going on. Now this part is very, very important to the students. So now this part is known as the capital adjustment. On the basis of the new partner's capital, we are going to rearrange the capital of other partners. Now this part is capital adjustment, first point. So how we can understand, how we can bifurcate, which method we are following. That also the students early morning, some students are asking to me, sir, how we can find out this, whether it is a capital we want to rearrange or we want to find out. Very simple. You know that they are given already, the new partner's capital is given, and on the basis of that we are going to rearrange the capital of other partners. That means the new partner's capital is given. And the second method is the new partner's capital is not given in the question. So then just go through T.S. Rival's book, illustration number 49, and also exercise number 77. So you will get the example for illustration 49, and also T.S. Rival's book, exercise number 77. You will get all this method very easily. They are given explanation. Now please come to the second method. So the new partner's capital is not given in the question. How we can find out the new partner's capital account? So listen, first method is known as the new partner's capital is given, and on the basis of that we are going to rearrange the capital of other partners. Now here second method is known as the new partners capital is not given. See example, A and B are partners. Their old ratio is given, that is 4:3. A and B are partners. Their old ratio is given, that is 4:3. So they are going to appoint a new partner C, 1/4 share in future profit. They are going to appoint a new partner C for 1/4 share in they are appointed a new partner C for 1/4 share in future profits. So here the combined capital of A and B is given. So A's capital is 85,600 and B's capital is 71,700. So here your adjustment, the last part they are given one adjustment. On the basis of the combined capital of A and B, you can find out C's capital, or find out C's capital on the basis of other partners' capital after taking all adjustments. After taking all adjustments, find out other partners' capital, and on the basis of other partners' capital, we can find out the new partners' capital account. Now you can see our example, A and B are old partners, the ratio is 4:3. They are going to appoint a new partner C for 1/4 share, and also their combined capital is given in the question, or you can find out my example, the combined capital of A is 85,600 and B's capital is 71,700. So now you can take the total, that is 1,57,300. So on the basis of this, you can find out C's capital. So how to calculate C's capital? That is, the C's ratio is equal to 1/4. That means 1 minus 1/4 is equal to 3/4. So the total capital is equal to 1,57,300 into reciprocal 4/3 into 1/4. So C's capital is equal to total capital into 4/3 into 1/4, that is 52,433. So 52,433. So this is the new partners capital. You can see this is a little easy method. The previous method, you know, we want to find out the new ratio, and also the calculation is a little tough, difficult. But here, you know, it is very easy. The ratio is given 1/4. 1 minus 1/4 is equal to 3/4. So 3/4 is only the A and B's capital. So we want to find out the total capital. That means A plus B plus C is equal to 1,57,300 into 4/3 into his share, or C share is equal to 1/4. That means C's capital is equal to 52,433. So now it is clear. So admission part is over. So you can see that admission is the 8-mark question. Now we are thoroughly studied this part. So once again I will repeat. So at the time of admitting a new partner, what are the problems or adjustments which is made by the existing partners? You know, the main point is change the profit sharing ratio, or we want to find out the sacrifice ratio, that is old ratio minus new ratio. The second point, that is the treatment of goodwill. You know that is very, very important, because lot of methods are there, like average profit method and super profit method and capitalization method. So depend upon the question and which method you are following. In the question adjustment they are given, so you should calculate goodwill on the basis of the profit what they are given. Sometimes they are given on the basis of the average, or sometimes they are given the find out super profit, or sometimes they are given capitalization. Depend upon the adjustments, we can find out the goodwill adjustment. And third point, you know that revaluation of assets and liabilities. That is also equally important, because so you are sure that the adjustments, so otherwise you will make mistakes. So appreciation or depreciation, or assets are undervalued. This also making confusion to students. So assets are undervalued means credit side, and overvalued means debit side. You know, it's a very, very important adjustment, because sometimes, you know, they are given assets are undervalued. So undervalued means we are taking credit side, and overvalued means we are taking debit side. Then afterwards find out the difference. The difference may be a profit or a loss. That means the credit total is more than the debit total, means we are getting a profit, and vice versa, we are getting a loss. So that is the third adjustment. And the fourth adjustment, you know that the this one, distribution of undistributed profit. And the last point is capital adjustments. Capital adjustment means, you know that a proportion the new partner's capital is given, and on the basis of that you can find out new partner's capital. And sometimes the new partner's capital is not given, so that also you can find out on the basis of other partner's capital after taking all adjustments. Now look at this question. This is a very simple question. This also, you know, 2000 modified compartment question. So all of you just look at the monitor, see the question. P and S are partners in a firm sharing profits in the ratio of 3:2, and their balance sheet is as follows. So they are given, so bank overdraft and creditors, provision for doubtful debts and general reserve, and V's loan and capital account of P and S. So here P and S are partners in a firm sharing profits in the ratio of 3:2, and their balance sheet is given. And here V's loan, that is the main point. So that V's loan is, we are going to convert it into a capital. And cash in hand, debtors, bills receivable, stock and building and land. So these are the main items, they are given here. And also adjustment. On 1st April 2015, they admitted a new partner, V, and also we will get 1/9 share in the profits of the firm. And V's loan will be converted into his capital account, and goodwill of the firm is valued at rupees 80,000, and we bought in share of goodwill in cash. A provision for doubtful debts was to be made equal to 5% of the debtors, and stock was to be depreciated by 5%, and land was to be appreciated by 10%. Prepare a revaluation account and partners capital account and balance sheet of P and S and V. So that means now you can see the adjustment. The first adjustment, you know that the loans, V's loan is converted into a capital, so that have no connection with the revaluation account, and goodwill also have no connection with the revaluation account. Now you can see the provision for doubtful debts to be made equal to 5% on debtors. So that means the balance sheet liability side, in this question, the previous part, they are given in the question, provision for doubtful debts is 1,500. And also, see, just look at the previous page. So you can see the provision for doubtful debts 1,000 they are given. So here look and see, balance sheet liability side, provision for doubtful debts is 1,000. Now you can see they are given in the adjustment is, the adjustment they are given, the provision for doubtful debts was to be made equal to 5% of debtors. That means, so 5% of debtors is equal to 1,500, but they are already given 1,000. That means, so this year our liabilities or our expense will be, that is 500, or liabilities are increased by 500. And again stock is depreciated. So next adjustment is, stock was depreciated by 5%, and we are calculating 5% that we are putting into the debit side, that is 2,500. And next adjustment, you know, land was appreciated by 10%, so that is 14,800. Now you can see from the question itself, so the credit total is more than debit total. That means the profit is transferred to partners capital account credit side. Now profit is transferred to partners capital account credit side. Now look at, see, next page. So look at the next page. They are given partners capital accounts. So partners capital account, first you can see the last, their capital account balance by balance brought out, And also I told you the second adjustment, V's loan is converted into its capital. That means by V's loan account 20,000, and the premium, the firm's goodwill is given. Find out his share, that is total 10,000, 1 by 8 of 80,000, that is 6,000, and 4,000 is divided according to sacrifice ratio, and the revaluation profit also divided according to the old ratio. So now general reserve, that is undistributed profit. So from the this particular problem itself, you can understand what I had given last my explanation. So first point is the last year's balance, and the second, the premium is transferred to partners capital account, and third point, you know that revaluation profit we are transferring to partners capital account credit side, and undistributed profit also transferred to partners capital account. Now we are taking the balance. So that balance is, you can see the piece capital balance is 1,22,080, and also S capital is 1,94,720, and V's capital is the 20,000. But here one problem is there, that means the V's loan is mutually, we are converting into capital, that means our cash is not increasing. Now look at the balance sheet, their capital account is there, and also creditors and provision for doubtful debts is 1,000 plus 500, that is 1,500, and bank overdraft is, you can see 20,000, and asset side, land plus appreciation and building, bill receivable, and debtors and stock is depreciated. Cash, the cash already given in the last balance sheet, that is 8,000, plus the new partner is bringing goodwill, that is 10,000. So our total balance sheet is 3,88,000. So that means, admission part is now over. Now we can proceed to discuss the retirement part. See, what are the problems faced by the existing partners at the time of retirement? It is just like admission. See, what are the problems we are going to discuss or we are facing at the time of retirement? See, now listen. So next we can proceed to discuss. See, what are the problems faced by the existing partners at the time of retirement of a partner? You know that just like admission, now we are going to discuss under what circumstances a partner may be retired from the firm. Under what circumstances a partner may be retired from the firm. So as per the contract, a partner may be retired from the firm, and also with the consent of all other partners, a partner can retire from the firm. So here my point is the retirement of partners, and under what circumstances a partner may be retired from the firm. So our point is a partner can be retired from the firm with the consent of all partners, or as per the contract a partner may be retired from the firm. So the next point is at the time of retirement, see what are the problems faced by the existing partners or continuing partners. At the time of retirement, what are the problems faced by the retirement of a partners or partner? Retirement of a partner. So here what are the problems faced by the continuing partners at the time of retirement? So here the existing partners are again facing the same problem, that is what is called, they want to find out the ratios. So we want to find out the new ratio. So that is what is called a new profit sharing ratio, and simultaneously we are going to find out gaining ratio. So how to find out gaining ratio? The new ratio minus old ratio is equal to gaining ratio. So the problem number 1 or adjustment which is made by the existing or continuing partners at the time of retirement is they want to find out gaining ratio. And the second point is just like admission, again treatment of goodwill is there. So that means the retiring partner's goodwill is adjusted by other partners, or treatment of goodwill, mainly the firm's goodwill is given and also the retiring partner's goodwill is adjusted by other partners. See example, A and B and C are partners. So here B is retiring and B's share of goodwill is adjusted by other partners by passing a journal entry is A's capital account debtor and C's capital account debtor to B's capital account. See once again, so here B is retiring and B's share of goodwill is adjusted by other partners. So that is what is called A's capital account debtor and C's capital account debtor to B's capital account. That means A and C is losing and B is getting. But this calculation is based on gaining ratio. So the calculation, that is gaining ratio, based on gaining ratio, new ratio minus old ratio. So this is the second point. The first point is they want to change the ratio, and the second point is the treatment of goodwill, and third point is just like admission, that is they want to find out the revaluation of assets and liabilities. And next point as usual, that is the distribution of undistributed profit, and the last point is capital adjustments. So here you can see the previous example. A and B and C are partners and B is retired, and A and C can reconstitute the firm. So the new firm's capital is given in the question, and also on the basis of that, so we are doing some calculation, that is the proportionate method under retirement. We want to find out some capital adjustments. So after retirement, what about the new partner's capital, and also the cash adjustment or current account adjustments are there. So that is the last adjustment. Now we can look at once again. So the retirement, see what are the problems faced by the existing partners or continuing partners. So point number one is they want to rearrange the ratio, that is what is called gaining ratio. And the second point is the treatment of goodwill, that means the retiring partners goodwill is adjusted by other partners according to gaining ratio. And now you can look at one example. So here XYZ are partners and their ratio is given here. That means old ratio is 2:3:5. See, look at this example. X, Y, Z are partners. Their old ratio, X and Y, Z are partners. Their old ratio is 2:3:5. And X retires and the new ratio is given 1:1 or equally. So who is leaving? So here X retires. X, Y, Z are partners. Their old ratio is 2:3:5 and the new ratio is given, that is 1:1. So here we want to find out gaining ratio. So what is our formula? New ratio minus old ratio. New ratio minus old ratio is equal to gaining ratio. So that is 2/10, and also that is A's Y's ratio, and also Z ratio is equal to 1/2 minus and 5/10, that is, so 5 minus 5, that means 0. So your gaining ratio is equal to 2:0. Only one partner is getting gain. So here our journal entry is, or ratio is equal to 2:0, or gaining ratio is equal to 2:0. So now you can see one example. So example is A, X and Y and Z are partners, and here X is going to retire. So at the time of retirement of X, so their goodwill is already existed in the firm. See, at the time of retirement of X, the goodwill is already existed in the firm is 50,000. The goodwill existed in the firm is equal to 50,000. Our ratio, gaining ratio is equal to 2:0. So my question is, X, Y, Z are partners, and at the time of the retirement of X, so here X, Y, Z, and X is going to retire. So here at the time of retirement of X, the firm's goodwill or the goodwill already existed in the firm is equal to 50,000, and goodwill of the firm is valued. The goodwill of the firm is valued rupees 45,000. So how you can pass the entry? So here you can see this is a 3-mark question. So you can expect question like this: at the time of retirement, the goodwill is already existed in the firm, and also the goodwill is valued rupees 45,000. So we want to find out or pass the necessary journal entries. So first journal entry is, this existing goodwill should be written off according to the old ratio. This existing goodwill should be written off. So our journal entry is X capital account debtor, X capital account debtor, and Y's capital account debtor, and Z's capital account debtor to, so goodwill account. So goodwill account. So that means this 50,000 should be divided according to their old ratio, that is 10,000 and 15,000 and 25,000. That means total is 50,000. So you can see the existing goodwill is written down according to the old ratio. That means at the time of retirement of X, the firms have already existed goodwill, that is 50,000, and the new goodwill is valued rupees 45,000. And when we are calculating, we are getting a gaining ratio is 2:0. So then how we can calculate? So the ratio is the retiring partner share we supposed to calculate, and also the ratio will, the journal entry will be Y's capital account debtor, Y's capital account debtor to Y's capital account debtor to X capital account. Y's capital account debtor to X capital account. That means Y is losing and X is getting. So that means X share of goodwill is adjusted by other partner according to gaining ratio. Here gaining ratio is 2:0. That is why only Y is adjusting that goodwill. That amount is known as 9,000. So that means here X share of goodwill is adjusted by Y according to gaining ratio. Now you can see one by one. So at the time of retirement, so next chapter, that is retirement of a partner. At the time of retirement of a partners, what are the problems faced by the existing partners? It is just like admission only, 1 or 2 points are extra, that's all. So first point is we are going to find out the new ratio, and also simultaneously we will find out gaining ratio. And the second point is the treatment of goodwill, like the retiring partners goodwill is adjusted by other partners. And the third point, revaluation of assets and liabilities and distribution of undistributed profits, and capital should be rearranged or capital should be find out, or the capital is already given, that should be rearranged according to the new ratio. And deficit and excess should be adjusted through cash account or a current account. So these are the points. So what we are going to see in the retirement. Now afterwards, you know that just go through the exercise numbers and also NCRTC plus TS Rewards books, and just go through the board examination last year's board papers. So there they are given the retirement question, and the last part they are given the adjustments. So these are the things what I am going to discuss today. And the next episode we are going to discuss the death of a partner plus dissolution of a firm. And you know that last year board examination, the board is asking the retirement or death and also dissolution in a typical type question they are asking. So that's why next episode is very, very important to students, because I am going to discuss death of a partner as well as the dissolution. Now, so this is the time for winding up. Thank you very much. You know, this is my third episode, so we can see in the next episode with the new chapters. And also So once again, thank you very much.